Assalamu alaikum and a good day to you all. I begin in the name of Allah, the most kind, the most merciful. Bismillahir Rahmanir Rahim. My name is Safwaan Navlakhi and I am a Shariah Advisor at Albaraka Bank, the only fully fledged Islamic bank in South Africa. I am excited to introduce you to Islamic banking, something you may have heard about or noticed on your bank's website and wondered, what is this all about? As part of our Money Smart Week, Albaraka Bank would like to share with you, the consumer, the various Islamic banking opportunities and products available to you. You will learn from this presentation the basic principles of Islamic finance, how Islamic banks work, and why Islamic banking products are accessible and suited to everyone, even those who are not of the Islamic faith. By way of introduction, Islamic banking is a system of banking that conforms to Islamic law, also known as Sharia. Is Islamic banking only for Muslims? Although originally designed to meet the needs of Muslim customers, Islamic banking products are accessible to everyone. What makes it so different? Because of its special focus on ethical and sustainable investing, Islamic banking is particularly attractive to ethical and social impact investors. The principles and laws enshrined in Islamic banking contribute to shared prosperity and real economic growth. In the next slides, we will elaborate further on each of these points. Let us head into the basic principles of Islamic finance. The first is interest or usury, which includes charging interest on money. This is prohibited in Islamic law. Islamic law requires the owners of capital to invest directly into the real sector in order to be entitled to a return. This ensures that when the rich get richer, their wealth creates jobs and prosperity for everyone, and they also participate in the downside. Islamic law prohibits contracts with uncertain outcomes, like conventional insurance, lopsided contracts which benefit the party with stronger bargaining power, and excessively speculative contracts, such as certain financial derivatives and gambling, since such contracts often give rise to dispute, settlement risk, and social economic injustices. Let us just ponder over a simple example. Should John purchase 10 kilos of salmon from the fisherman in the morning prior to the fisherman catching any fish, it is possible that the fisherman may catch other fish besides salmon or catch less than 10 kilos of salmon. This will result in him being unable to fulfill his obligations to John. It is also possible that once the fish is caught and delivered, John may not be happy with the quality and refuse to accept it. There are various possible causes for dispute and non-settlement in such a contract. It is therefore required that the salmon be specified and deliverable at the point of transaction to remove any uncertainty. Gambling is also prohibited. Gambling is a zero-sum game with adverse socio-economic effects. Islamic law characterizes gambling as devious and illicit means of acquiring wealth. An innate characteristic of exchange contracts is that it is for mutual benefit. Islamic laws require that economic agents earn their livelihood from the sweat of one's brow. Islamic finance is geared towards ethical and impact investing. Islamic law discourages and in some instances does not permit investment in sectors of the economy that engenders harm to society and or the environment. A prime example of an impermissible sector is the alcoholic beverage industry, the social harms of which are self-evident. Let's now take a look at how Islamic banking works. Islamic banks accept two types of deposits. The first is an interest-free deposit, which is used for transactional banking. Since the funds deposited in transactional banking accounts are guaranteed deposits, the depositor is not exposed to any commercial risk. The depositor may not receive any return in lieu of funds held in this account. Hence, the funds deposited in this type of account are accessible to the depositor on demand. The second type of deposits are in the form of investment accounts, which are profit and loss sharing deposits. Investment accounts are usually structured on the basis of mudaraba, which is a profit and loss sharing partnership, or wakala, an investment agency. Islamic banks utilize funds from deposits to provide finance to clients who require it. These are some of the main financing instruments used by Islamic banks. Ijara. Ijara is a lease instrument used to finance durable assets such as vehicles and equipment. The bank purchases the asset and leases to the client over the finance term. There are a number of rules which set Ijara finance apart from conventional finance leases. Murabaha is a cost-plus instrument used for asset and trade finance. In Murabaha, the bank acquires the asset and sells it to the client at a pre-agreed profit markup. The client pays the price in installments over the finance term. Diminishing musharaka is an equity financing instrument used to finance real estate assets and to advance venture capital. Here, the bank purchases a share in the property and sells it to the client gradually over the finance term. Alternatively, the bank can finance certain projects and participate in profit and loss. All these finance instruments earn profit which is shared between the bank and investment account depositors in proportion to a profit-sharing ratio. The profit-sharing ratio is pre-agreed with the depositor when opening an account. In the unlikely event of no profit being earned or a loss incurred, no profits will be allocated to either party. So what is the Islamic banking value proposition? What does it bring new to the table? Risk sharing. In an interest-based financial system, the owners of capital can grow their wealth with little or no exposure to commercial risk. Islamic finance promotes sharing of profit and loss between owners of capital and investors in the real sector. Interest-free banking. A loan is a kind gesture to fellow humans by nature and should therefore not expect a return. Islamic banks do not charge or pay any interest. Distributive justice. The interest-based financial system perpetuates economic disparities and accumulation of wealth in the hands of a few, as we see today. Islamic finance splits commercial risk between owners of capital and real investors, promotes investment in SMEs, and contributes towards social justice. Real sector investment. Islamic finance directs funds to productive assets or investments in the real sector to expand the economy and create jobs, and promotes technological innovation, economic growth, and shared prosperity. In conclusion, as you have probably realized, Islamic banking is a feasible option for everyone. Although it serves as an alternative solution for Muslims, it remains attractive for others who are conscious about ethical and impact investments. The Islamic banking model is consistent with the ideals of shared prosperity and sustainable economic development. Many world leaders have expressed positive sentiments in respect of Islamic banking and consider it a possible solution for the recurring financial crises with devastating socio-economic effects. After the 2008 financial crisis, Pope Benedict XVI urged financiers to look at the Islamic financial system, where bankers have found to manage risk better since depositors take interest in the type of risks banks take, since depositors are directly exposed to these risks. Unsurprisingly, Islamic banking has earned and drawn the attention of all major financial institutions, including the World Bank and the International Monetary Fund. I thank you for your attention and for listening to this presentation. Thank you.